Hi, welcome to another video of Property Expert Academy. And today we are going to look at the next point from our top 5 tips to invest in property in 2020. And we're going to learn about how to gear up our property portfolio. So while I'm loading up this screen, if you will please subscribe to our channel if you haven't done it already, so that you will not miss any of our upcoming videos. So we are going to share a lot more information here and a lot more knowledge. So please hit the subscribe button. So if you have not seen our previous videos, please look look out for them, like they are in our, yeah. So if you have not seen our previous videos, you can still watch them again. They are on our channel. So look at for week 1, week 2, like that, and then you will find the previous videos if you have missed them. And then, as I mentioned, so if you can subscribe to our channel so that you will not miss any upcoming videos and you are always getting notified first as soon as the video comes. So let me begin. So, just to recap, we have a few weeks ago we started with this series 5 useful tips to invest in property 2020, and there was the 5 things that we learned was like buying property with positive cash flow. There was a video we created for that. So if you have missed out that one, please go through the previous recorded video. You will find it's quite useful how to calculate, cash of for a property. And today we are going to go through this buy below market value to gear up your portfolio. And then in next coming week, you'll be seeing about locations, property portfolio, how to understand its gearing ratio and all. So let's begin with our today's one, which is buy below market value property to gear up your property portfolio. So we'll be discussing this thing by using few examples. We'll use like a scenario one where we are not, where we're buying property without even using mortgage. Scenario two where we'll be buying property with mortgage and how it impacts our property portfolio. Scenario three where we are buying property with mortgage and also we are buying them below market value, and see how much impact that will have on our property portfolio going forward. So let's see them more in details. So scenario one, if you see in this one, since it's going to be a lot of numbers today, so I'm going to be very slow today, so that you can understand this. So in the scenario one, as you can see, we have amount. Let's say, so I've taken it like for understanding purpose, a figure of 100,000. Maybe you can use whichever country you are in, put your own currency mark here, dollar, pound, or whichever currency you have in your country. Yeah, so let's say in this scenario one, we have purchased a property worth 100,000. Now, these are all the hypothecations, assumptions that we have taken just for the purpose of education. So let's say if this property that we bought for 100,000, if that was supposed to give us 5% rental yield, we are going to make 5,000 pound in a year. Of course, this is just for assumption purpose. So give and take all those, expenditure things that we discussed last time. So imagine like this is what you're getting net, or like take into account for all those things as well. But for now, we'll just take it as like 5% we make, keeping everything else like expenditures, maintenance and all on one side, or purchase price. In the purchase price, we haven't even taken stamp duty and all. But this is, as I mentioned, for example only. So let's say if you make 5,000, 5% of the your purchase price of the property, uh, then you're making 5% through the rental. Then you're also making, let's say in that property in that country wherever you're buying it, or in that particular location, you are going to get 5% annual growth. Again, this is based on the assumptions. You can always work it out based on the research. You have your house price index or the graph of the property prices in your area. So we may probably go through that more in details maybe in some other video. But today, for the purpose of understanding this gearing part, we're just going to keep this more simple. So in scenario one, what we have noticed here is, so we get, by investing 100,000, a 5,000 pound from the rental income, and on an average a notional growth of 5%, which is another 5,000. So let's say when you have 100,000, you invested without taking mortgage, you got 10,000 pound worth of profit. So 5,000 immediate, 5,000 gets added into your property portfolio. Now, now what we are going to look at is, let's say we go into now scenario two, where imagine that same 100,000 that we had, we now split in this into 4 properties. So because we are taking a mortgage this time. So same 100,000 property. Now we are buying four of those properties instead of one, because we are able to put 25% deposit for all four properties and manage to borrow 75% from the bank. Now again, since this is for a purpose of understanding and studies, I've taken up a rate of interest as 2.5%. It may vary, depends which type of property you are mortgaging for, the type of your personal circumstance, or like whether you're taking in company name or personal name. But let's take it 2.5%. So what I've done is at 75,000, I've said that okay, 2.5% of that interest that we are paying works out to be 1,875. Now, if you will calculate 2.5% of 75, this is the figure you will get. Same I've done for property 2, property 3, property 4. So now since you managed to get four property with the same down payment of upfront 100,000 investment, now you managed to get these four properties similar uh, loan that you're going to pay, and 5% taking the same percentage now gives you now 5%, which is 5,000 each on each property. Now, when we look at it, income after, because in the first scenario we did not have a mortgage payment, so I have not taken that into account. But in this scenario, we are taking the mortgage payment into account. So net we are making is 3,125 after making the mortgage payment. Again, we have taken the rest of the other expenditure or things on assumption basis that this is after taking all that in account, a figure that we get except the mortgage payment. So now after taking mortgage payment out, it's going to give you 3,125,000 pound net. Now, some of you might probably find it a bit fast pace as I'm speaking. I'm trying still to, speak as slow as possible so you can understand. I know this is numbers, so sometimes it's difficult for some people to understand this. For those, I would say you can always, pause this and then replay again. Now, if we see, so based on that, previously when we worked out a 5% rental yield, now what we are saying is return on investment on capital that we employed, which is based on this 25,000. So if we are saying if we make 3,125 pound, euro, whatever, based on 25, we are making a 12% return on our actual invested money because we paid anyways the bank's money. Same we applied to all four properties, we got this figure. Now, imagine now the same annual growth which happens in that area is 5% of I mean, this is an average I'm saying, so it may grow up or down, but let's say average 5% for understanding purpose gives us another 5,000 pound worth of notional capital growth in that each property. So that way we are getting 5,000 each times 4 property, and I've calculated here the rental which we managed to get is now 12,500 by investing the same money that we invested in scenario 1, and we managed to get the notional capital growth of 20,000. So in total we made now 32,500. This is where many times people do miss. Now some people say, do not borrow too much, or and we will be discussing more in details, in terms of like how we should understand our property gearing ratios and all. But see, the example is in front of you. The same 100,000 which was giving in the previous scenario, only 10,000 pound, which means 5,000 rental, 5,000 of capital growth. Now the same 100,000 has managed to make you 32,500. Are you getting my point now? Here you see you have almost tripled your profit by, you know, leveraging with the bank's money, by borrowing the money and using your skill set to invest in four properties rather than one, right? So there are many other things around, but this is just for understanding. So now let's look at the scenario 3 where we are buying. So this is again, you're buying the properties, right? And then this is growing as per the every year growth. And then which means when you buy one property, you have to wait for a few years before it goes up in value. And then you can always uh, release some more equity going forward. But then that means you have to wait for a few years. Yeah. So that's why we say this is notional. Now, in the scenario 3, where we are buying the same 100,000 pound worth of property at 20% below market values, let's say now it's 80,000. So we have taken the same properties example. We've now bought below market by 20% each, taken that to equation. So there's a typing error at the end one, but ignore, yeah, 80,000 each. This is 80. So now using a 25,000, so we this time we only put 20,000 pound down payment rather than 100, but this is just for the purpose of understanding. So I've used it 80,000 only here rather than 100,000, which means you still have 20,000 more. So remember, you can even do now 5 deals rather than 4 deals. Yeah, so that's why I'm saying add 25% extra for this. And again, I'm going to show you what we can do after 6 months as well on this type of deals. So, so which means now this is two. I think because I could not put everything into this slideshow. So imagine there is one more here at the end. So 5 properties together. So we'll anyways add another 25% on this. So let's say 20, 20, 20. That's what we invested. So now instead of 4, we managed to buy 5 property. On this chart, it's showing 4, but imagine it's fifth, 5 as well. For everything you calculate, it's times 5. Same way, we now borrowed money from the bank, 75% loan to value. Why we say 75 is because that's where you get the best interest rate from the bank, and you're not really, under, I mean, you're not even over stretching or under stretching as well. So we'll discuss that more in details as well. So now again, using the same rate of interest of 2.5%, this time since the money that we borrowed was below because of the below market value became less as well. So instead of 75,000 in the previous situation, now we are only have to borrow 60,000 each. That way, buying 5 properties, each of those property, the mortgage payment will come to like 1,500 pound a year. Now imagine the same property, we have now 5% of rental income that comes to 5,000 each, because 5% we are taking based on the overall actual market value, but we are buying below market value, so therefore we still taken the same 5%. Now you see there is another uh, benefit here is when you're buying below market value, automatically your rental yield goes up. I've just put down here 5, but effectively it's more, because when you work out 5% on 5,000 based on 80, it works out even more than 6% yield. So this is another thing is because you are straight away increasing your uh, rental yield. Yeah, so imagine you do this times 5, then income after mortgage payment works out to be 3,500, which was previously 3,120 or something. So you've managed to now get more in hand income. Now again, if you look at it, return on capital employed, it was previously 12 and a half. Now you managed to get 17 and a half, which is a huge, like almost 50% extra jump from the previous figure. Yeah. So you times that by 5, then again your annual growth 5,000, that remains straight. You times that by 5. In this calculation, I've taken this 4 because you can only see 4 here, but then we are going to add 25% extra since it could not come in the screen. So now in the previous scenario, we managed to get less rental income, but this is 4 times 12,875, and 4 times growth of each property works out, let's say 20,000. So gives us 32,875. Now you add also another, as I mentioned, 25. So you would add maybe, let's say, so 32 plus it around 40,000 plus. Yeah. So now in this situation, you manage to make 40,000 extra, and you in this scenario you also get another additional benefit, which is that in 6 months time, since you have already bought below market value, you can go back to the bank, because normally there are many lenders who will say that you can't refinance within the first 6 months, but there are some cases we may discuss more about that in upcoming videos. But in this video we are just focusing on the numbers and the gearing. So on an average now people wait for 6 months, because that's how the most lenders policies are. So you go back to the bank in 6 months time and then ask them to borrow another, what, because if it is 100,000, of course you will also add value. So first you are buying below market value, so you're making 20,000 pounds straight immediate equity on day one, plus you might of course also add value, but in this scenario I've not taken that into account, but that is also a bonus for you whatever you add. So even let's say imagine if remains only 100 even in 6 months time, you have not, let's say, added any other further value or refurbishment or anything you've not done, or any extensions and all. So you still have that £100,000 worth of value. 6 months later, you can go back to the bank and then you say, Mr. Bank, can I probably borrow another 25% of additional equity? They will come revalue, and this time rather than purchase price, they'll give you 75% off market value, which will become then, instead of 60, you will get 75, which means you manage to get £15,000 magic money from each property. So 15,000 times 5 properties, 75,000. So imagine with the 75, you can really double up your property portfolio. You seeing how this gearing working, how this basically number game increasing your portfolio much quicker. This is how many people have made hundreds properties very quickly. They've invested and grown their property portfolio because they understood this part, how to really re-gear it, how to, because it's a compounding game. Like you go with 1 to 4, 4 to 8, 8 to 16, and like it goes on. And then over a period of time, in few years times, you really find yourself like financially free, because then you don't really need too many property just to be financially free. Once you've reached to the stage of 5 to 10 property, or even sometimes you only need one property, that can make you financially free. It depends of what type of rent it gives you, what type of strategies you've used. We may be discussing more in detail, but the message here is, by gearing up your property portfolio using bank's money and buying below market value, give, giving you additional advantage. So let's say in this scenario, first is you managed to get, like, let's say in the scenario one, we were only getting 10,000 approximately additional money making every year from a property business. But if you're doing in this case, now effectively speaking, you've gone to like 400% extra return. Plus in 6 months time, you'll be reborrowing. You will of course refinance again, and you'll get mostly, all of the fund which you have invested here out of this property portfolio, which means you have hardly any money left in your portfolio. Even many times we've done a deals where there is no money left in a deal, because we managed to just borrow. I mean, we managed to just release everything out of the property after we have added value. Because imagine, like, if you're buying at 80, right, and then 100,000, something which was worth 100, you're buying it at 80, you made immediately 20%, plus you will add value. Let's say you'll make it 120 or something. By, of course, you may have to add some, I mean, you may have to spend some money, let's say 10,000 pound to refurbish and all. But at 120, you'll go back to bank and then borrow 75%, which is 90,000, which means once you've done that scenario, you will have no money left in the deal, because everything is, you got it back. In fact, you got over than what you spent initially. So this is what we mean by gearing up, and then utilizing your portfolio, gearing ratio well. We'll be also discussing, of course, don't worry, I mean, you can replay it again if the numbers are not that, clear. So you can pause, play again, go slowly, understand it. And we'll be, of course, doing another video where we'll go more in details as well. As we mentioned, there are some more points. Um, so guys, thank you very much for watching, and please do subscribe if you have not done so, and watch out for our next videos, and please like and comment and share with your friends and family. Thank you very much. See you next time.